fundsupermart.com.
Hello everyone. The real estate theme has been popular among global investors over the years. With us today is Stephen Hayes, Head of Global Property Securities of First State Investments, who shared with us his outlook on the sector. Hi Stephen, thanks for joining us. The recovery of the U.S. property market has been rather slow. What is your view on the U.S. property fundamentals?
Well, the underlying US property fundamentals are actually pretty strong. So we've seen an economic recovery in the US that's been slow and grindy, but been going on for quite a number of years now. So what that has meant is the demand has come through for commercial assets, that is tenant demand. We haven't seen a lot of supply, generally speaking. In fact, the supply's been fairly limited. So if we look at each of the individual sectors within the US, what we are seeing is very high occupancies. If we look at our US malls, for instance, they're very high, well into the 90s. The same with industrial warehousing. Hotel occupancies are now, for five-star hotels, are now into the 80s. Office building occupancies have been increasing in some of the CBD markets as well. The apartments are effectively structurally full now over in the US. So the underlying fundamentals are pretty good. And what we're witnessing with occupancies being so high and fairly limited development increasing supply is that we're seeing rents go up. So the net operating income out of the buildings themselves is actually growing and growing quite rapidly. So the cash flows are strong. The only lagging market is probably the office, and particularly suburban office, but even now we're getting a sense that there is demand trickling back in that particular sector. But if we look at some of the West Coast office markets, West LA and San Francisco, those markets are actually fundamentally very strong. In fact, San Francisco, I'd put up with the West End of London as being the strongest office markets globally.
With global financial markets being increasingly sophisticated in recent decades, what advantages do property investments offer?
Well, that sophistication also rolls over into real estate. So there's been many countries globally now that have actually introduced tax transparent legislation or REIT legislation right around the world, where the actual entity owning the real estate does not pay tax. That tax gets any income coming from that investment to unit holders or shareholders is taxed in their own hands. So the sophistication as far as the structures in which the real estate is owned is has also improved and rolled out right around the world, and we've seen with the introduction in Japan and Singapore and Hong Kong, for instance, within Asia, of tax transparent REIT legislation. On top of that, we have seen over really the last decade or more a huge instance of property coming out of the hands of private owners, banks, insurance companies, wealthy families, and being publicly listed into the publicly traded markets or securitised. And what that has done, it has meant there has been an extra level of expertise that has been garnered to manage these particular assets. So the sophistication has gone right through into the property sector without a doubt. Also on top of that, with the assets making their way into REIT type structures that are listed, they've also got generally very good access to capital. And that's both debt and equity. And that's very, very important with regards to commercial investment grade property, because these assets, they're long duration assets, they're fixed assets, but they're capital intensive assets, require a lot of money to be spent on them through a cycle, either redeveloping or repositioning the assets, simply maintaining the assets and offering incentive to lease the assets.
From a valuations point of view, is it a good entry point for global property securities? And do you favor any sectors in this space?
Well, on the first point, I think what we've witnessed since the GFC is a lot of the REIT share prices doubling or tripling. Now that is from a very, very low base at the point when they were materially oversold. But with developed countries right around the world, post the GFC, trying to stimulate their economies, clearly some of them have introduced quantitative easing. The UK, the US, Japan. And that has kept interest rates very low at the long end. And also the central banks have also reduced the short end of the interest rate curve close to zero, depending on the country. So we've had very, very low interest rates, historically low interest rates, for an extended period of time, and that has fueled, I suppose, demand for financial assets, including real estate. So real estate prices are actually pretty high in the physical real estate markets in most countries around the world, particularly the developed countries, with those sort of quantitative easing programs or very low interest rates, which has flowed through to the publicly traded markets. So the valuations look okay, but they don't look compelling. And we're probably going to see into next year the Bank of England start to raise interest rates, as well as the US Fed start to raise interest rates. And that could see some pressure on capitalisation rates of the buildings themselves, which may see a bit of pressure on their valuations.
What are some of the major risks that investors in the property market should be aware of?
I think probably the primary one is the potential for the short end of the interest rate curve to start increasing in those developed countries as central banks start raising those interest rates as a part of the normalisation of economic growth continuing on, particularly in the US and the UK. You would have to think that some inflationary expectation is going to come through at some stage, which will mean that the long end of the curve, that's the sovereign cost of debt, will start to move up as well. So I think interest rates moving up is probably the biggest risk to valuations. Underlying assets are in pretty good shape, and we're at a point in time, I suppose, globally, where global GDP growth in the developed countries is trending up. Which means the real estate is going to be in a better economic environment and will be underwriting higher rents. The buildings will be well occupied, and we're not seeing that supply side risk as yet. And for office buildings and shopping centres, it takes a long time to build these assets, get your approvals, and actually complete them. So we're not expecting any supply shocks at all, with demand continuing on. So the underlying real estate fundamentals are actually pretty good globally, and we're expecting that to continue as economic growth continues. But the overriding risk is interest rates going back up. Other than that, you've got the usual exogenous risks that we all think about, like geopolitical risk out of what's happening in the Middle East, and really the potential for Ebola to come from what is an endemic sort of issue now into a pandemic issue. And if that does transgress over time, well, that could put pressure on all stock markets, including real estate.